Your savings account paid you 5.3% interest last year. This year, it might drop to 0.5%. Your credit card rate? Still 24%. Meanwhile, your company just announced a hiring freeze. These aren't random events. They're all connected to the same economic shift that's happening right now in ways most people don't realize. When economists say the word recession, they're measuring something specific. 2 consecutive quarters where GDP contracts. But what does that actually mean for the money sitting in your account, the debt on your statements, and whether you'll have a paycheck next month? The mechanics are straightforward once you see how they work. A recession is officially 2 straight quarters where the economy produces less than it did before. That's it. The National Bureau of Economic Research makes the official call, but the definition is simple. Less economic activity. Businesses sell fewer products. Companies hire fewer workers. Consumers spend less money. This creates a cycle. When people worry about their jobs, they cut spending. When spending drops, businesses earn less. When businesses earn less, they lay people off. And those layoffs make more people worry. The Federal Reserve tries to break this cycle by adjusting interest rates, which affects almost everything in your financial life. During the 2008 recession, the average savings account interest rate fell from 3.8% to 0.2% in just 18 months. A $10,000 emergency fund went from earning $380 per year to $20. The Federal Reserve cuts interest rates during recessions to encourage borrowing and spending. Banks immediately pass those cuts to savers. But here's the asymmetry. When rates drop, your savings rate falls within weeks. When rates rise again, savings rates climb back much slower. This happened again in 2020, when rates hit near zero and stayed there for years. If you have variable rate debt, like a home equity line of credit or an adjustable rate mortgage, your payments might actually decrease during a recession. Those rates are often tied to the prime rate, which follows the Federal Reserve's moves. But credit card rates? Most stay high because they have huge spreads built in. The average credit card rate in 2008 stayed above 14% even when savings rates hit zero. For new borrowing, things change fast. Banks tighten lending standards. They want to see higher credit scores, larger down payments, more income verification. This is called a credit crunch. The money exists, but banks become much pickier about who gets it. Someone with a $50,000 home equity line of credit at 8% was paying about $333 per month in interest-only payments in 2007. By mid-2009, after the Fed cut rates to near zero, that same HELOC dropped to around 3.5%. Their monthly interest payment fell to $145. That's real money back in their budget. But when they tried to open a new HELOC or refinance, banks wanted 20% equity minimum instead of 10%. Credit score requirements jumped from 680 to 740. The existing debt got cheaper, but new credit became much harder to access. During the 2008 recession, unemployment peaked at 10%. But that number masks huge variation. Construction workers faced 21% unemployment. Manufacturing hit 13%. Healthcare unemployment stayed below 6%. Government jobs were largely protected. Your recession risk depends heavily on your industry. Service sector jobs that depend on discretionary spending get hit early. Technology jobs often see hiring freezes before layoffs. Essential services stay relatively stable. The unemployment duration also matters. In 2009, the average unemployment spell lasted 24 weeks, double the normal rate. Companies don't lay off randomly. First comes the hiring freeze. No new positions, no backfills. Then contractors and temps lose work. Next is voluntary buyouts for long-term employees. Then come the actual layoffs, usually starting with recent hires and roles furthest from revenue generation. Marketing, HR, administrative positions often get cut first. Customer-facing and production roles tend to last longer. Seniority provides some protection, but not complete immunity. During the 2020 recession, 22 million jobs disappeared in just 2 months, but the pattern held. Support functions went first. Core operations lasted longer. A marketing manager hired in 2019 at 75,000 saw her department shrink from 8 people to 3 by summer 2020. Her role was eliminated in the second round of cuts, with unemployment benefits maxing at $450 per week in her state. She went from $1,440 per week gross to $450. The federal pandemic bonus added $600 temporarily, but that ended. It took her 7 months to find comparable work, and she had to accept $68,000 instead of $75,000. Her emergency fund covered 4 months. Credit cards covered month 5 and 6. Month 7, she moved in with family. This sequence is typical for white-collar recession unemployment. During recessions, stock prices typically fall first, often 6 to 12 months before the recession officially starts. The S&P 500 dropped 38% from October 2007 to March 2009. But if you kept contributing to your 401k through that period, you bought shares at deep discounts. Someone who invested $500 monthly from 2008 through 2010 and held until 2020 saw those specific contributions grow by over 300%. Housing prices usually drop too, but with a longer lag. The Case-Shiller Index fell 27% peak to trough from 2006 to 2012. Recovery took years. Most recessions last 8 to 18 months officially, but full recovery takes much longer. After 2008, it took 4 years for unemployment to drop below 7%. It took 6 years for median household income to return to pre-recession levels. Stock markets recovered faster, hitting new highs by 2013. But if you sold in panic during the crash, you locked in losses. Housing took even longer. Some markets didn't see 2006 price levels again until 2016 or later. The timing matters enormously. When you need to access savings, sell assets, or find work determines your personal recession experience more than the recession itself. Historical patterns show a few things that correlate with better recession outcomes. Emergency funds that cover 6 to 12 months of expenses provide runway when income drops. Skills in recession-resistant industries like healthcare, utilities, or essential services offer more job stability. Low fixed costs mean less pressure when income decreases. Modest or no debt removes the forced payment burden. Continued retirement contributions during market drops historically lead to strong, long-term returns. None of these guarantee protection, but the data shows they reduce recession impact severity. The key is understanding these mechanics before they're needed. A 2019 Federal Reserve survey found that 40% of Americans couldn't cover a $400 emergency expense without borrowing or selling something. When the 2020 recession hit months later, those households had no buffer. Meanwhile, households with 3 months of expenses saved were 5 times more likely to maintain their standard of living through unemployment. The difference wasn't income level. Plenty of high earners had no savings. Plenty of modest earners had solid emergency funds. The difference was preparation. Understanding recession mechanics means knowing what to prepare for before it matters. Recessions affect your money in specific, predictable ways. Savings interest rates drop fast when the Federal Reserve cuts rates to stimulate the economy. Variable debt might decrease, but credit cards stay expensive and new credit becomes harder to get. Job losses follow patterns based on industry and role, with support functions typically cut before core operations. Asset prices fall, but recover at different speeds, with stocks usually bouncing back faster than housing. Emergency funds, recession-resistant skills, and low fixed costs historically correlate with better outcomes. The mechanics are knowable. The preparation is possible. Understanding what actually happens removes some of the fear around the word recession. Everything covered here is for educational purposes only. This is not financial advice. Every situation is different. Consider speaking with a licensed financial advisor before making any major money decisions.